Hi, guys. I'm Tim Melvin. Welcome to another Friday afternoon. I've got my weekend duds on. I'm ready to go in Memorial Day. Gonna try to put a dent in the national charcoal supply with a little barbecuing and hanging around the pool. We'll get some time for reading in there and working, but it's 3 day weekend. Hope everybody's in a position to kick back, enjoy it with family and friends, and just make the best of it. Um, we're in a weird market right now. There's no other way to put this. We had a nice rally this week, snap back some of the territory that we've been losing. But guys, when I look at fund flows this morning, I saw that there's been 8 weeks of money leaving high yield and emerging market income funds. Cash is still gushing out of tech stocks right now. Energy is at new highs. They don't care how much we release out of the strategic oil reserve. Energy is just creeping up to stealthy new highs almost every day. We've seen about $28 billion just pulled out of investing altogether and added to cash. We saw the largest outflows from floating rate loan funds since April of 2020. Guys, these are all massive risk off signs. You would think markets would go down, especially with money leaving tech stocks, which have been the market darlings. Nope. Just saw the biggest inflows in 10 weeks. And of course, the S&P 500, as I said, is up on the week for several weeks. So it's a strange market, and you try to make sense of everything that's going on. You will go crazy. Best as I can tell right now, long-term momentum in the market still remains extremely negative. We're way below the 200-day moving average still, but short-term momentum has decided to rear its head and give a little rally as bulls have come in and tried to do some bottom fishing. I don't think we're anywhere close to bottom fishing. We get down to 32, 3,300 and more reasonable valuations on the S&P 500. I'd be willing to start having the conversation about bottom fishing. With Microsoft still trading where it is at 10 times sales with a rather sporty earnings multiple, we're not in a place where bottom fishing is the rule of the day. Very confusing market, I think, in the short term. In the long run, all this stuff does tend to sort itself out. But if you think the market is confused, boy, think about the average consumer out there right now, guys. Consumer sentiment numbers came out today, and they're awful. They're at a 10-year low. Everybody's terrified about what inflation might do to the U.S. economy over the next several months. However, they're still spending money, guys. This economy is not weakening up yet. Look, I know Walmart and Target numbers were terrible. That had as much to do with supply chains, some of the lower end consumers absolutely staying home, and rising wage pressures. Retail has had its problem. It's going to continue to have problems. However, when you look at credit card spending out there, it's shooting higher. Bank of America and JP Morgan, two of the biggest issuers of credit cards, have said that, it's not just bigger numbers in credit card spending than it was in 2021. We're like 30% above what we were spending on our credit cards pre-pandemic. We're also seeing savings balances go down for 4 months in a row. Guys, consumers may be saying that they're worried, but they're not acting like it. A worried consumer is not running up bills on the credit card. They're hoarding cash, not spending it. They're saying one thing and doing another, which just kind of adds to the general confusion. So I try to stay with the numbers. They're out there, they're spending. If that changes, yeah, it may put a drag on the economy. Guys, we've only had one rate hike. And I know everybody looked at those Walmart and Target numbers last week and said, oh boy, the Fed is not going to have to raise interest rates as far and for as long as we thought. That's insanity. We've done like one big 50 basis point hike so far. We're going to do two more of those. Then we're probably going to do a hike every month until May of 2023. And Fed funds rates will be 3.25%, 3.5%. And you'll have a 10-year well over 5. And the stock market isn't going to like any of that. And that may slow down consumer spending. But I want you to think about something for a second, because everybody's worried about housing and housing slowing down because of higher mortgage rates. My parents bought a house back in the 70s with like a 15, either 12 or 15%. I can't remember what my mom told me the number was, but it was huge mortgage rate. But they still bought the house, and I don't think the 5, 6, 7% mortgage rate is going to Get a guy who's living with his wife. They both got pretty good jobs. They're living downtown in a big city of the United States, and they just had their first child, and they're kind of walking that baby cart along on a nice sunny spring day, and they're looking down and they're seeing condoms and hypodermic needles in the gutters, and there's crime in this allegedly nice neighborhood around them growing. Am I making that up? No. That's exactly the reason that my daughter and her husband and my grandchild live about 3 miles from the house. They had exactly that experience. They loved where they lived in Chicago. I kind of liked it too. I could walk to Wrigley Field. But all of a sudden, it wasn't how close you were to Wrigley Field. It wasn't how late the Thai restaurants were open or how late you could get a cheesesteak. It was about schools and shopping and parking and all the other things that a young family deals with. The millennial family formation, and I forget what we call the generation behind them. It might be Gen X, or that could be before them. I get lost. But the generation behind them is also going to be coming into the early stages of the years of desiring to start a family. Remember, millennials were very late. They saw everything that happened from 2000 to 2010 with 2 massive market crashes and unemployment problems and financial crisis and housing going down. They just really didn't want anything to do with it for a while, and I can't say that I blame them. However, they're getting there. It's providing me with some grandchildren, which makes me really happy. And I don't think that we're going to see enough of a slowdown in the economy from the Fed's activity, at least in 2022, to do any serious damage to the housing market. And I certainly don't think they will drive inflation back under 2%. Remember, Powell told you, Esther George, the Kansas City Fed president, they've told you, okay, job one is inflation back under 2%, no matter what it does to the stock market. They're not going to pause. They're not going to take the foot off the pedal until inflation's under 2%. And because of massive energy shortages, especially in diesel, which is critical because there's not much that doesn't get to market without diesel being part of the supply chain transportation. We don't have refining capacity to fix that very quickly, making the Fed's job that much more difficult. I've always said this, that being the Fed chair, I said it about you, Janet Yellen. I'm going to say it about Jerome Powell. This is the worst $200,000 a year job in the world. The commitment and to the pain level that you have to endure as the chairman of the Federal Reserve is it's somewhat awe-inspiring, especially for a guy who worked for Carlyle in private equity. So he's already a gazillionaire and probably wishes he was back doing deals again. But anyway, that's where we are. I don't think we're going to see the kind of slowdown that's going to stop the Fed from raising rates. We're going to see a steady stream of interest rates hike. Eventually, the market's not going to like that, and the long-term negative momentum will reassert itself. So what do we do? That's scary. What do we do? Nothing, mostly. I mean, I could be wrong. I'm not a great market prognosticator. I'm certainly a terrible short-term stock trader. So we're going to do nothing. We're going to let valuation speak for itself. We are looking to add more small banks to our small bank portfolio. We're doing so much better than banking indexes and stock market indexes and the big tech guys this year. We actually, I think, are a little bit in the black in that portfolio when we account for dividends. So we've got some that are pretty close to our buy points. If we can get them there, we're absolutely going to buy those. We've got a bunch of banks already in the portfolio. And as I said, small banks are doing much better than big banks or just about anything else this year. So we're thrilled with that. And if you've been watching my videos as I've come along, the various services, we did a bunch of traders agencies last year. And now we're just doing them kind of freeform for ourselves for a period of time. And we've got some other things that we're going to be doing. But if you've been following me along, you know that I've been on the MLPs and the MLP closed-end funds for over a year. And I still say, if you don't own them, it's not a bad idea. We've got MLPs in our portfolio that have starting yields, yield to cost of over 10%. And these things are going up on a regular basis. We're seeing dividend increases, and it's not going to go away. There is no new oil and gas infrastructure being built in the United States. And of course, we had bought selective oil and gas companies as well, including Tellurian, Crescent Energy, and a few others over the last year that have done extraordinarily well. So we don't really feel the need to run out and do anything unless we see some banks hit our price point, and I am watching some special opportunity trades. The first one, and those of you that were with me back at Heat Seekers years ago before they foolishly canceled that particular service that has done very well since, one of our stocks there was Turtle Beach. The symbol is HEAR. They make headphones, high-end gaming headphones, the higher-end headphones that you would use to stream movies on your laptop and not upset everybody else on the airplane, still have good sound quality. So high-end headphones for a wide range of consumer electronics products. It's a fantastic company. Great products. Management has made some mistakes that have impaired cash flow. They did attract an activist, and the activist is winning this round, guys. They've gotten 3 board seats from the folks at Turtle Beach. And Turtle Beach has said they're going to put themselves up for sale. They're going to look for a buyer. They should not have problems finding interesting buyers, and they should be able to get a price. Stocks around 18 and change of between $25 to $28 a share, according to my pencil. So I think there's a real opportunity here. By the way, if they don't sell this thing in 120 days, which is that's 4 months, they have to give the activist firm a 4th board seat, at which point the activists are going to have control and do pretty much whatever they want. So there's an opportunity here. We're going to do this in the options market. Okay. The stock's at 18 and change. We're going to go out to September, expiring September 16th, I believe. And the fair value of the September 15 put is $1.30. So I think that if you can sell that over the next couple days for $1.30 or more, that's going to create a pretty good trade. You're going to have a $1.30 off of 15, giving you an entry point into the stock of 13.7. The options premium you're going to collect is about a 9% premium, giving you a 36% annualized yield. If the stock is put to you, you're going to own the stock at a little less than 9 times earnings and about 7 times free cash flow for what is basically a pretty good company that has a strong presence and is, in fact, the headphone of choice of many of the computer gamers that I know. So that's one kind of special situation. And every week I try to give you one stable, steady, high yield idea, just to be a nice guy about it, I guess. This week we're going with Gladstone Commercial. The symbol is GOOD. It's a real estate investment trust that does single tenant office or industrial properties. And on a select basis, if they have a real strong anchor tenant that's taking substantial amounts of space, they will consider doing a multi-tenant triple net lease property business. They've got 131 properties around the United States, 27 different states, 97% occupancy rate, 7 years, a little over 7 years average left on the leases. In a triple net arrangement, the tenant pays all expenses, they pay all insurance, and they pay all the taxes. All we have to do as the owner of the building is collect all these streams of cash that are coming into the door. Now, they've got 19 different industries. 51% of this property is industrial, 45% of the office, but the office space is people like Tower Watson, General Motors, Verizon, large companies, and companies that have their headquarters in regional companies. So excellent tenant credit quality profile for their tenants. If you can hear in the background, you now know 2 things. The UPS man is here, and I have dogs. So anyway, listen, this company's been growing at 15% since 2012. They've never missed or lowered a dividend, which is pretty impressive since they've been public since 2003. They came through the credit crisis, okay? They've got a strong credit portfolio. Debt is just about 46% of total asset values. They're really going to be refocusing, looking to maybe dispose of some what they consider to be non-core properties in maybe weaker cities and towns to focus on industrial in strong markets with decent population and income growth. The management at Gladstone's been around for a while. When I was at a regional brokerage firm in Annapolis, Maryland, we did a bunch of IPO deals with Gladstone and some of his REITs and BDCs. They've been around a while. They're personally invested in it. They own a lot. I think it's an outstanding income investment. It's currently yielding 7.6%, and it does pay on a monthly basis. So everybody, get out there, make it a great weekend with family and friends. But keep in mind, there is a reason for Memorial Day. I don't always agree with the reasons that we have sent troops overseas to do battle in the name of our nation. However, I do always respect the commitment the bravery and the patriotism of those we have sent. So if you get a chance this weekend, raise a glass, raise a can, whatever it is, to the memory of those who did serve and who did give all in the belief that they were working and fighting to make the world a better place for the rest of us. Happy Memorial Day, everybody. And I'll talk to you at some point next week. I will, once again, as I always do, I'll try to get to you early in the week, but it's probably going to be next Friday again. Have a fantastic week, guys, and thanks for watching.